The numbers on the screen were lower than anyone expected. 1.3 billion euros in profit. To most a fortune, but to the markets, it was a miss. Heavy maintenance, weakening chemical markets, a system under visible stress. Yet in the middle of this downturn, a massive move was being made. A 2.8 billion euro move that signals something far deeper than a simple earnings report. In the high-stakes world of global energy, things are rarely as simple as they appear on a balance sheet. For the Italian energy major Eni, the start of 2026 brought a series of numbers that seemed to point in two different directions at once. On one hand, there was the adjusted net profit, 1.3 billion euros. It fell short of what analysts had predicted. The cause was clear. The refining and chemical sectors were showing signs of weakness. Large-scale downstream maintenance was weighing the system down, pulling on the company's immediate momentum. To an outside observer, it looked like a moment of cooling, a period of slowing down. But then the perspective shifts. While the headline focused on the miss, a much larger narrative was being written in the background. Reported net income sat at $1.5 billion. But it was the decision regarding the future that caught the industry off guard. Eni didn't retreat. Instead, they raised their share buyback to 2.8 billion euros. At the same time, they lifted their cash flow guidance from operations by 20%, targeting 13.8 billion. It is a move that suggests a hidden strength beneath the surface of temporary maintenance cycles. Deep within the company's upstream operations, production is not just steady, it is accelerating. In the second quarter, production is expected to rise by up to 4%. For the full year, the trajectory remains the same. The focus is shifting geographically, moving with intent toward key regions in Africa and Southeast Asia. In Southeast Asia alone, the target is becoming clear. 500,000 barrels of oil equivalent per day. This isn't just about pulling resources from the ground. It's about a new way of structuring an energy empire. Eni is moving toward what they call a satellite model. It's a strategy designed to accelerate cash flow through the year 2030, aiming for 17 billion euros in operations cash flow. The goal is a 14% compound annual growth rate. They are keeping their gearing low, between 10 and 15%, ensuring the system remains lean even as it expands. But this expansion looks different than the energy booms of the past. The strategy hinges on independent entities designed for a changing world. Enilive is moving to triple its biorefining capacity. Plenitude is pushing to significantly increase renewable capacity. These aren't just side projects. By 2030, these two entities alone are projected to generate 5.5 billion euros in EBITDA. It is a self-funding, low-carbon engine designed to sit alongside traditional energy businesses. Together, they are targeting over 40 billion euros in cumulative free cash flow through the end of the decade. While the internal structure of the company transforms, the external map is changing as well. A new deal has been struck. Eni, alongside Spain's Repsol, has reached an agreement with the Venezuelan government. The plan is ambitious. By the end of 2031, they intend to begin exporting natural gas. The partners are looking at the offshore Perla field, aiming to more than double its output. By 2028, they want 1.2 billion cubic feet per day flowing from those waters. The gas won't just stay in the region. It will be processed as liquefied natural gas through a new floating terminal, ready to be moved across the globe. But as the infrastructure grows and the buybacks increase, the central question remains. The downstream maintenance is a present reality. The refining markets are still showing their teeth. The company is betting billions that their satellite model can outpace the traditional cycles of the energy market. They are building a system designed for growth in an era of uncertainty. Pushing through a profit miss to double down on their own value, the infrastructure is being laid. The capital is being deployed. The ships will eventually begin moving from that floating terminal, one after another, carrying a new future for the Perla field. But the transition from a traditional giant to a collection of high-growth satellites is a path filled with technical pressure and market volatility. If the refining weakness persists, can the upstream growth and the biorefining targets carry the weight of a 17 billion euro cash flow goal? And if the global energy balance shifts before the first gas leaves the Venezuelan terminal, what becomes of the 40 billion euro promise?